Good afternoon, everyone, and on behalf of the entire team of Edelweiss Mutual Fund, welcome to our third annual open house. As I said, this is the third year that we are conducting this open house, and the response to this gets better and better every year. So, thank you. For those of you who are joining us for the first time, I want to take a step back and talk a little bit about why we are doing this open house. I think this open house is an important step in communicating with all of you as investors and partners about what our funds did last year and what they are positioned to do next year. This is not a conversation where we spend a lot of time talking about markets, but a very focused and specific conversation where we spend time talking to our investment team, the people who manage your money, and ask them how they managed your money last year. Honestly talk about what went well and also what didn't go well, and also how they see the future. So it's intended to be a very focused conversation, and we hope that it gets better and better. It's also a chance for you to ask your questions on our funds to our investment team. And while some of you have sent questions in advance, I would encourage you to send all your questions to us, and we'll try to take as many of them in the live show as possible. Otherwise, we'll answer them later. In terms of the agenda today, this year we've done the open house a little bit differently from last year. We focused on two segments. We are going to spend the bulk of today's time with our long-only equity team, talking about various long-only funds, small cap, mid cap, flexi cap, large and mid cap, and their performance this year. And then we're going to spend time with our hybrid and solutions team talking about two of our flagship funds, Balanced Advantage Fund and recently listed IPO fund. Some of you who have attended this in the past may be wondering why we've chosen only to do these segments and not cover some of our other funds such as fixed income and international funds. We all believe we have limited attention spans, and it's important to do a focused and deep conversation. So today's conversation focuses on equities and hybrids. For those who do have conversations on international funds like China and US tech, we would be very happy to answer them, and we will be conducting a separate and dedicated session on them at a later point in time. And again, if you have questions on fixed income, we're happy to answer them offline. I also, before I get started with the first set of speakers, that is our long-only team, just wanted to spend a few minutes talking about our philosophy of managing money and how we think about fund performance, because we think as an investor or partner, it's very important for you to know what we think performance is, what kind of outcomes we are driving ourselves towards, so that you have the right expectations. Now, for us, I think consistency in performance is extremely important. We do realize that we run open-ended funds. Investors come in at different times, and we want to make sure that the experience in aggregate of our investors is a good one and is a consistent one. So internally, when we talk to each other, we focus on being quartile 1 and quartile 2 in the 1 and 2 and 3 year parameters. And we believe that if we do that, in the long term, we will beat our benchmarks and be very competitive in our peer groups. And a fund, for instance, like mid-cap fund, which has been around for more than 10 years, I think is an example of doing that beautifully. We don't aim to deliver outsized returns or be top of the charts in any single year, but rather focus on consistency of experience. So, you will often not see our funds as rank 1, 2 or 3 in 1 year, but you might end up seeing them in those kind of ranks or in very healthy positions in a much longer term. We also believe, finally, money management is about staying invested for the long term, and compounding really, kicks in then. And that's why this philosophy. This philosophy and this outcome is achieved by a very important input, and that is our investment process. And in our conversation with Trideep and the equity team, we will spend time talking about what kind of investment process we run to drive the outcome that I talked about. But in short, long-term consistent performance, quartile 1 and quartile 2 in the short term, a focus on avoiding big mistakes and delivering meaningful wealth creation to the investors. So With that, let me kick off. I would like to welcome our long only equity team first. Let me just quickly introduce the team so that you all know who is behind managing your money. Tradeep is here, he's our equity CIO. Sahil is here, right? Sahil is right there, he can raise his hand. He's the primary manager on our small cap fund, also the co-fund manager on our mid cap fund. Abhishek is here. He's the fund manager on our large and mid cap fund and also the co-fund manager on our focus fund. Ashwini is here. He is our in-house specialist on financials and also the co-fund manager on our flexi cap fund and our ELSS fund. And Mehul plays a very interesting role. He's our specialist on forensics and ESG. And in the course of this conversation, you'll hear from all of them. But Tradeep, let's start quickly with your thoughts on the equity market and then move into the fund level discussion on understanding the fair investment framework that you follow while picking stocks.
Thanks, Radhika. Good evening, everyone. And the equity market view that I'm going to talk about comprises of two parts. One is what we call as near term, which is the, let's say, calendar year 2023, and then what we think about over the medium term, which is the next 2 to 3 years. One leads on to other. And around about January, we came about this theme for calendar year 2023. We called it recession before rebound. And what it in a sense it means is, given that we have seen a rather focused rise in interest rates of almost 400 to 500 basis points in the second half of 2022, the economic impact of that is likely to follow through in the first 6-9 months of the year. And during this time frame, we would see contracting growth rates, we would see probably contracting expansions and stuff like that, post which rates would peak, inflation would peak, and gradually rebound would start. Net-net, we have been cautious for the first 3-6 months of the year. It is just as speaking to you as we speak, we are roundabout in the twilight zone, where gradually it seems like maybe over the next 2 or 3 months rates would actually peak, inflation might actually peak, and in a further 2 or 3 months we would probably see economies bottom out and pursue its own course. And that's when the interesting part of the equity journey really starts for an investor. From there on, since middle of 2024, we would have elections, and post that, I think the 3 or 5 years that we see for Indian equity markets is something that I haven't seen in the last 10-15 years. That is what I think is worth playing for today, if you ask me, from an equity market perspective for investors. Now, for that to happen, we first need to go through 2023 recessionary conditions overall, and this can be seen as an accumulation phase for investors, particularly kind of as we go towards the year end. So that, in a nutshell, is how I think about equity markets over the next 2 to 3 years. You might ask that just to set the ball rolling amongst all of us, that what are the areas that we would be kind of really hinging our positivity over the medium term on, and I would point towards 5 of such themes. The first and foremost and the thing that we are most bullish on is basically the private sector driven capex cycle. We think in India, for the first time in the last 10-15 years, there is a good chance that we will see a private sector capex cycle come through. This is reflective across our positioning in multiple funds, and you will hear more from my colleagues as we go by. But for the first time, capacity utilization across India Inc. is hovering around 74-75%, post which we usually see capex cycle stand to happen. We think that is the first time post 2002-2003 that we are seeing this, and it's a meaningful way to profit from the markets over the medium term. That's first. Second, after going through a good round of NPS cycle and consolidation, we think that lending financials are in a good place to be. That's the second spot where we are overweight, and we think that overall as a fund house one could benefit from over the next couple of years. The third area that we like is basically on the real estate side. We think that real estate overall is probably in the first 2 to 3 years of a 7-year upcycle, and both direct and indirect plays are a good place to be as a theme from an equity market standpoint. And finally, I think the North Block in India has realized that manufacturing, if one has to promote, then one has to create scale. And one way to do that is basically indigenization of defense, and secondly, basically taking market share away from China and Europe plus one. These are just pointers which I wanted to lay in front of you at the beginning of the outset, at the beginning of this conversation, just to set the ball rolling, and you'll hear more from my colleagues as time goes by, as they talk about their own funds. But these are the 5 themes that generally at a top-down level, and these have sectoral implications that we are positive on and we are banking our bets on from a portfolio standpoint. Now let's come to the investment framework. Between the equity market view and the investment framework, the investment framework always wins. The reason why that is the case is because ultimately we want to build a story, as Radhika says, around the philosophy of consistent performance. Equity market views can change, equity market conditions can change, but the process or the framework that we follow, if we follow diligently, I think that leads to consistent performance, which is what we are aiming for. So with that sort of preview, what are the key investment pillars of our investment framework? And if I were to say that, I would say there are mainly 4 investment pillars around which we center our investment philosophy on. First is, and we call it FAIR, whether you like it or not, FAIR, and it stands for forensics, acceptable price, I as in ESG informed, and R as in robustness. And let me sort of briefly cover what they are, and if you are paying attention, as most of our colleagues speak, you will find elements of this which they can relate to this, and that's the essence of what we are trying to achieve in our equity investment team. So first is forensics. One of the niche AMCs smart enough to dedicate a dedicated resource in this direction. Mehul, my colleague, is sitting, who will talk a little more about that. But in essence, what we are trying to do there is go beyond the P&L, balance sheet and the cash flow to understand if there are any telltale signs, how we can spot trouble before it really manifests into a catastrophe, and kind of to clear us off of many debacles that may happen before they happen. As we go forward, we might see some more examples of that. Certainly don't want to steal the thunder from Mehul. Second is what we call as acceptable price. This is a very important part of how we pick stocks. We think that until and unless we have an upside of at least 20%, taking a position into the stock doesn't kind of go well with investors and the return expectations. So the acceptable price, following on valuations and maintaining the discipline, is one of the core second pillars of our investment hypothesis. Third is what we call as ESG informed. Now in here, what we are humbly trying to say is that we are mindful of where the company exists on the ESG curve. This is not a stock picking tool, but it just increases the awareness within our team, and as we engage with companies, where they stack up in the overall value chain. And finally, and most importantly, we look at companies which are robust business models, i.e. for whom not just growth but margins, profitability and return ratios are also important. So these are the 4 cornerstones of our investment philosophy, and if I put all of these together, what we want to stand for at Edelweiss MF long only equities team, we want to stand for a team which is the bottom up stock picker. We are interested in financially clean companies. That comes out of our forensics. We are interested in companies that can grow sustainably and have robust business models, and finally they are available to us at an acceptable price. This in essence is what we do, Radhika, on a day-on-day basis, and hopefully over the last couple of years we have been able to show some results, but I can assure you there is more to follow.
Thanks, Pradeep, for that. Just following on that question, people usually, and investors often ask this question, people usually bucket their strategies into either value investing or growth investing, and I know we don't give out any kind of explicit investment theme. So how would you answer this value or growth question in the context of our investment philosophy and FAIR?
I think it's a great question or great dilemma that people have. We all grew up reading about that. I fundamentally believe that value and growth are joined at the hip. if a company doesn't have valuations, which we covered in the acceptable price part, it doesn't give you future returns. At the same time, if the company is not robust business model, or there is not growth or profitability, it doesn't add to returns. So net, I would probably kind of take the middle path that Buddha would say, that ultimately we are stock pickers, not leaning towards either value or growth. We think both should be part of the portfolios, and ultimately, as long as the combination they make sense, it makes good stock. It makes it a good stock to own from a portfolio standpoint.
And so what you're saying is that companies are not either value companies or growth companies. There's no either or, and what
Correct.
you're looking for is really what you said in the FAIR framework, which is robustness and yet acceptable price.
Correct.
And that is the middle path. Now, the next question that I have, either Mehul or you can answer, but since we talked about forensics, if you could give investors some examples of how forensics, some specific examples of how forensics have helped avoid mistakes in the recent year.
Trust me, today is an ideal day for doing that, but we won't get into stock specifics. But I would say that over the last couple of years, trust me, we've had many such examples. But the ones that come to mind was basically, remember we talked about in the name of forensics that we go beyond P&L, balance sheet and cash flow to look at if there are any telltale signs that something is amiss. And in one of the companies that we were analyzing, we figured out that the fees in audit fees were materially higher than the revenue growth, and that made us question if there are any questionable governance practices being followed. And when we looked at it in further detail, we found quite a few. In another one, we kind of looked for. We found something on the ESOP side. Mehul, can you elaborate?
Sure. Yep. So when we were actually looking at this investment case, it was a people solutions company. I won't take the name, but essentially, there was a good fundamental upside that we were looking at, close to 20-30%, and everything on the business side seemed good, but when we went in deep, we saw that the revenue growth didn't match up with the auditor fee growth. So auditor fee was growing exponentially versus the revenue. The board was very inconsistent, low quality. They were not using the best practices. There was a sea of subsidiaries with the company. A lot of related party transactions were happening, and as a very big red flag, we saw that there were advances given to promoter entities, which were subsequently written off, right? And although fundamentally the business looked good, these were red flags for us, so we didn't enter, right? And if you see today, that stock is probably corrected by close to 25-30% from there. This is a case where we didn't enter, right? And what we generally do is whenever we are evaluating a new name, we run it through our whole scanner, our whole checklist, and on a periodic basis, we also do it for our holding companies. Similarly, in another frontline pharma company, something which we hold, the quarterly disclosures came out, right? Result ended and quarterly disclosures came out. Again, this company, one of the fastest growing company in the pharma space, and high margins, best margins, supposedly a very good segment of the market, very strong management guidance. Fundamentally, it looked like a great piece of business to own, right? But essentially, when we looked through the quarterly disclosures, when the insider trading data came out, what we saw is that although the company was guiding and saying that things are so good, people all the way starting from the CEO, the CFO, the research head, the sales head, all the way till the general managers, all had sold 99-95% of all their holdings. Everyone had kind of exited the stock, and we were being given the picture that the business is so great, and we thought there's something amiss. And going through more disclosures, we found a lot more things on the corporate governance side that we saw, and we exited the stock at a loss of 5%, right? Then and there, because we said we don't want to hold this name. And it takes time. Sometimes forensics takes time. After 6 months, media got a sniff of some irregularities that I saw, and today that stock, there is the company has lost 50% of its revenue, and the stock is down by close to 60%. So there is a lot of value at looking at things which people are not, because we get lost in the standard things that analysts look at, like balance sheet and cash flows. And it's not just about creating wealth, it's also about preserving wealth. Both are very, very important things to do. And that is where maybe we don't see the results every day, because I can only see red flags, right? So I can see that there is smoke. I don't know how big the fire is. This is the way I kind of like to put it. But it really adds over the long time when you want to give a consistent output.
Thanks, Mehul. That's very helpful. What I'm going to do now is I'm going to move towards fund-specific sections, and I'm going to start with talking about our large and mid-cap and flexi-cap funds because they are in the same space. Now, starting with Edelweiss Large and Mid-Cap Fund, this is one of our oldest funds. It's got a 15-year track record. I would say the last year of performance has not been the best, but the 3 and 5 year numbers in this fund have been extremely competitive and well in line with our philosophy, and our 15-year track record in this fund is particularly strong. So I'm going to ask a couple of questions to Abhishek. Abhishek, let's talk about what has contributed positively to the fund's performance in terms of sectors and businesses first.
Sure. Thanks, Radhika, and good evening, everyone. I think let's just rewind a bit because clearly one has to set how we ran the fund for the last year, what was our thesis, and what worked well for us, right? If you kind of evaluate what played out last year, it was one of the most volatile year, if I can put it that way. You had various global as well as domestic events which were happening parallelly. So let me start with the global events. We had the Russia-Ukraine war, which kind of just came unexpectedly. Inflationary pressure was there for everyone to face. And as Tridip highlighted in his opening remark, we saw US increasing interest rate by a magnitude of 500 bips, which probably is what we have seen after 4 or 5 decades, this kind of a sudden rise in the interest rate. So suddenly everything was kind of just going through its own share of uncertainty. Come back home, we also had our own share of uncertainties regarding the inflationary pressure, as well as if you look at the front-ended interest increase also played out the role at a macroeconomic level, and this eventually led to some slowdown which we saw in terms of consumption, more specifically post-festivities. So this was the backdrop in which we were kind of running our portfolio on whole of last year. What we did, realizing that the global uncertainties were more pronounced, we kind of chose to have a more domestic oriented approach when it comes to selecting our portfolios. So there were 3-4 broader themes on which we ran our portfolio. The first important theme was, if you kind of recollect and rewind back a year, in CY21 there was this strong wage inflation which played out across country, led by financials as well as IT technology as a space. So we were backing on this high disposable income which was available to the end consumer, and we were investing in names which were driven by the high disposable income. So names like real estate, maybe derivative sectors out of that. That's one space where we were kind of counting positively on. The second space again, financials is another space where, as highlighted earlier also, we saw almost kind of a non-event kind of last 5 years when it comes to financial as a sector performance. There have been a lot of write-off, there have been a lot of cleaning of the balance sheet. So these guys were anyway starting on a very low base, and back that with the fact that we saw one of the strongest non-farm credit growth which came through, right? So that gives us another reason to kind of pull our kind of exposure towards financial as a sector. Another sector which we again kind of focused on as an opportunity was clearly that we were looking for derivatives, or in the sense that as we talked about the consumption, so on the durable side, let's an example of automobile, a derivative of automobile, auto ancillaries, because again there were a lot of uncertainties whether you're talking about EV, you're talking about the ICE engine, how to play that space. But we kind of chose to again position our portfolio in a way that first of all we expose ourselves to ancillaries which would not have been impacted either ways, whether you're talking about ICE engine or the EV engine. And on the auto side again, we kind of looked at opportunities where the business was in transition and they were leading the whole transition space when it comes to EV. So I think those are 3-4 main buckets. Obviously industrials and capex is something which, as Pradeep highlighted, has been our focus area across portfolios. There have been various reasons to own that space, and I'll probably elaborate it a little later. So those are 3-4 main buckets where we clearly kind of held on to last year, and that I think most of them did help us from a portfolio perspective.
That helps. Abhishek, now since you talked about what helped, what didn't work last year in terms of specific themes or businesses, or anything that you believe was a missed opportunity in the last year?
Sure. So Radhika, I think that's probably where the whole active investment comes into play, right? I mean, frankly, as I said, there were things which were changing or happening so fast that sometime you have to be a little more clinical in your approach. So maybe reflecting back, if I have to infer, maybe we kind of were a little more accommodative to some kind of changes which are happening at an economic level. Had we been more clinical towards it, this would have clearly helped. Now coming to sectors where we would probably could have taken more exposure. So one thing which we realized, as the interest rate was going up, clearly I think the investors' focus was moving away more from high valued stock, because by default the cost of equity was going up, and they wanted to shift focus towards more, if you can't call it as a bucket of value, but more safety, right? So the names or the sectors which were more seen as defensive, and where you typically see good dividend yields, space like OMC, space like PSU banking, space on those parameters, is something which did well, utilities.
Yes.
Now, obviously, this was something which took us a time to kind of evaluate it, and there was kind of a more front-ended return which was kind of taken or being shown by the sector. So that is one space where we could have probably done more. That's one part of it. And second component where again I say is that we saw the pent-up demand which was lasting for almost 2 years post-COVID, and this discretionary part, more specifically on the luxury side of the segment, like your hospitality, aviation, that part of the segment again kept doing well. And we in our assessment kind of thought that maybe this is the time when the pent-up demand is getting over. So the valuation has already run its course. Maybe there would be some moderation before it starts picking up again, but it did not play out that way. So I think those are two main buckets which we realized is where we were found lacking. But then again, as the saying goes, we have been kind of actively working on it. And if you see incrementally now, we have added a few of those names where again we get more comfort from a valuation perspective.
That's very helpful. I just wanted to pick on one thing which you mentioned, which was industrials. Now, the fund has been overweight on industrials for a while now. I think as a house we've been overweight, and that's worked. But can you elaborate as we go forward, what does the sector have to offer, and why are there still reasons to be excited about industrials? And it'll probably reflect on most of the portfolio.
Sure. No, as we have been saying, and maybe this is what 15-16 months running since we have been running our overweight on this space. So clearly this has been a space where we have been most bullish if you look at whole of last year and even this calendar year. I think it's kind of a situation and opportunity which, at least me covering this space for more than a decade, is something. It's like coming together of all the positive data points and news flow which is kind of now amazing to what we are seeing in terms of our exposure, right? Let me just call out few factors which gives a lot of comfort. To start with, there is inherent spend which is being done by both state as well as center at the government level, because they realize that this is one sector which obviously gives you a lot of impetus when it comes to even employment generation, and there is a clear-cut intent of India scaling up its ability on the manufacturing front to become export hub also globally. So the whole spend which has been done by government and both center and state is one part of the contributing factor. The second factor is, and which is also very relevant, which Pradeep highlighted, that if you look at private capex was something which was lacking so far, more specifically in the last 5-7 years. Looking at how the order books are now panning out, looking at again what kind of capex intent being shown by private sector per se, we can clearly see that there is a tacit and a visible uptick in the demand. The fact that capacity utilization at a sector wide level is more running at 74-75%, and we have seen the moment you cross this threshold and reach more towards 77-78, when the private capex takes a huge uptick, or it kind of picks up at a very fast pace. We are probably on the cusp of that. So that's another reason where we are pretty confident that the private sector can incrementally contribute towards it. As we have been saying, and this is where maybe the whole telecom evolution is now playing a role. You talk about automation, you talk about IoT, you talk about industrialization 4.0, all these themes broadly are nothing but kind of focusing on overall manufacturing of factory workflow, right? So those opportunities are something which will come through. Clearly data center is something where I think we have all heard a lot of things, whether the government wants us to indigenize things. I think just day before yesterday I heard the Amazon AWS CEO talking about AWS itself committing more than $12 billion in next 7 years towards data center in India, and this is just one company, right? So the opportunity could be in multiples of tens of billions of dollars. And lastly, obviously PLI, which no one can ignore. It's production linked incentive program which has been launched by the government of India. It helps you in achieving two targets. One, clearly the kind of magnitude of spend which has been committed gives you opportunity in terms of generating employment, because I think that's been one sore point which we keep hearing. So clearly this will help you in terms of generating employment opportunities at a large scale. as well as this will also increase the exposure of manufacturing as a sector towards the overall economy, and again make India as a global export hub. So I think these 4-5 things, along with defense indigenization, are the factor which come together and gives us strong visibility when it comes to industrial as a capex sector opportunity.
So you mentioned you've been covering industrials for a while. I also know that IT is a sector that you've been covering for a long time. Now our fund, this particular fund, has been underweight on healthcare and IT for some time. Investors have watched recent corrections in IT valuations. Do you think at this point IT, valuations have become attractive, and why have we been underweight historically healthcare and IT, at least over the last 1 year?
Sure. So again, let me remind you back. Technology as a space, we kind of ran almost an overweight for whole of 21. Come early part of 22, CY 22, there were two main things which kind of made us reevaluate our stance in the technology as a space. The first, as I highlighted, though at a consumer level it was a positive thing to happen, but at a company level or at a business level, the heightened wage attrition as well as the kind of wage inflation. So both of them, wage inflation and attrition level, were at a peak. That typically is not a good sign when it comes to looking at technology as a business, because it's predominantly driven by delivery. And if the delivery was going to suffer because of higher attrition, clearly this would have impact in terms of revenue, and high wage inflation will have its own bearing in terms of profitability. Second important thing is, so this was the kind of headwind which we saw on the sector side, and then come to the valuation. Now the technology as a sector was trading at a valuation which was almost 2 standard deviations from normal. Now typically at that point of time, more often than not, there is always a chance of valuation correcting, if not in absolute term, but time correction will play out its role, and that was the reason why we chose to go underweight by mid of CY 22. Whole of CY 22 we ran our underweight position because clearly we saw these things were not improving. Now came turn of this calendar, January, February 23, we clearly also came back to the drawing board, started evaluating, does it make sense now to reevaluate our underweight stance. We felt that yes, a lot of negative news is kind of getting baked into the price right now, but still valuation were not to the long term average level, as well as when we heard commentary from most of the management, or when we spoke to the third party or the third party consultants, it did not give us confidence that the worst is already baked in. So though incrementally we have been cutting down our underweight across portfolios, but yet we will be marginally underweight. We still waiting for the fundamentals to improve and give us comfort to change our view from underweight to overweight at this moment.
Thanks, Abhishek. Let me now move to another fund in the same space. This is Edelweiss Flexi Cap Fund. This fund's actually had a particularly good year. It's Q1 in performance against peers as of today. So I thought we could speak to Trideep a little bit about the fund. So Trideep, the first question is the same. What has contributed to the fund's performance in the last year, especially in terms of sectors and businesses?
Sure. Actually, before I answer that question, one small connection that I would like to draw with regards to the previous speakers is, when Mehul talked about forensics, that's the first F part of the fair that we sort of talked about, and it all, as different people speak, you will see all of the dots finally aligned to where we started with. That's one. And second, apart from being fund manager, he is also sector expert. I'm talking Abhishek here on industrials and IT. It's a nice mesh to have between portfolio management and build depth with regards to sectoral coverage overall, and it adds richness to the team. Coming to the question on FlexiCap, Radhika, I think what worked for us overall, if I were to look at between allocation and stock selection, both of them were quite favorable. The themes that we were overweight, and Abhishek mentioned about capital goods, that has been one of the big overweights in the sector that clearly worked well for us. Some of the other sectors that worked well for us was actually our overweight in financials, and given that we are somewhere in the first 2 years of or in the 2-year upcycle with regards to financials at least, and then we will evaluate furthermore. That helped us, particularly the lending financials. Our underweight on IT sector also helped. I think Abhishek rightly called out at the right moment that we were underweight the sector around about September, October last year, and the weakness in IT services was broadly captured in our portfolios over the last year or so. What particularly worked well was the stock selection within these sectors actually helped us get not only the sectoral theme right, but also the stock specific alpha that we can create which helped us getting to Q1 in the last year or so.
So similar question, thanks Pradeep. As I asked Abhishek, anything that, even though the funds had a good year, anything that you think didn't work in terms of specific themes or businesses, or anything that you believed was a missed opportunity as you reflect on the last year?
There are always things to improve, Radhika. And I think two areas where I kick myself, maybe we could have done better. Well, one was probably in autos, where I think our stock selection was not great. I think overall we were probably a little late with regards to the stocks we wanted to be in. We corrected this during the course of the year, but I think I could have probably done a better job at from an auto segment. Autos has been, it's a tricky sector to call, particularly because we were underweight consumption, and in the overall sea of weakness that we see, where do you put your bets on with regards to market share is a tricky call. And hopefully that has clearly worked well in the later parts, but in the initial parts it clearly held. The second area where we probably lagged was consumer durables. And I think, as you will note, that both of these are consumption sectors or consumption related sectors. So we got the sectoral call right, that we were underweight consumption, but within that some of the stocks that we held probably turned out to be weaker than what we thought. We anticipated to be weak, but it turned out to be weaker than what we did, and I think there were a couple of company specific events that also played out as well. Sometimes we wonder if we sort of when we say sectoral underweight, how much underweight should one be? So in the context of diversified portfolios, despite having those couple of mishaps, or rather missed opportunities, overall performance shows that our weightage in those areas were reasonably small. So net we came out fine, but where we could improve were those two areas that I would point to.
Pradeep, a question, since flexi cap funds can now move across the market cap range, how have you navigated between large, mid, small, the allocation? How do you think about the allocation? And another question that came is, are you going to be overweight mid and small cap now that valuations have corrected? So how are you thinking about market cap given the mandate of this fund?
Sure. I think one of the, as you rightly said, one of the advantages is to swing around the market cap, but it is also the toughest thing to do.
Yes.
So as investors, as a guiding principle, what we are looking to do is present in front of investors a diversified portfolio where the stock specific alpha really tops out, which is what I talked about when we talked about attribution. In essence, that we are looking to do within the context of that, to the extent that we have some sort of view, as we talked about recession before rebound and gradually things turning better, we note that large caps were probably a safer place to be.
Yep.
Over the last year or so. So we might have been slightly overweight large cap, and over a period of time we will gradually move to a certain extent towards mid and small cap, but these are all within basis points of what the benchmark allocation is likely to be. We are not looking to play that game. We have dedicated mid and small cap funds through which we play that, but rather than trying to play the same within the context of a flexi cap, we are ultimately trying to play the stock specific alpha across market caps. Sometimes the mid cap stocks do quite well, which we think if we get into rebound category of the hypothesis, mid and small caps would have gradually turned better, and we will evaluate that on a stock specific basis. So on net balance, in the verbose answer, what I am trying to say is that if that mid and small cap stock stands out by virtue of their stock specific hypothesis, sure, we will
Then
go
we'll pick
overweight mid and small cap, but not just as a category.
Understood. Let me now, actually, before I close this section, let me just ask, a final question on both the large and mid cap and flexi cap funds to you, Pradeep. The big positioning last year was domestic overweight, manufacturing side of the economy overweight, underweight consumption. That was the positioning. Going into this year, recession before rebound is the theme. What are the themes the fund is playing in this economic cycle, and do you see that positioning change?
And not much is answered. So we talked about the 5 themes that we are overweight on. fortunately, given how the economic cycle in India is planning out to be, the next 5 years looks like fairly robust. And as the different sector experts talk about that, you will see a lot more depth in that. But in a nutshell, we are overweight private sector capex, we are overweight lending financials, we are overweight direct and indirect plays on real estate, and then government specific themes like indigenization of defense and China plus one or Europe plus one. So in essence, fortunately, these are 4 5-year themes. So the stock selection within that themes change and subject to the market cap availability. But on net balance, our exposure to this across funds has remained the same, and particularly in the context of flexi cap fund will remain the same so far.
Perfect. So I think both you and Abhishek have also mentioned financials and the fact that we've been overweight on financials. So before moving to other funds, I want to come to Ashwini and talk about our views on financials and how he sees the sector, how he saw the sector in the last 1 year, and also how he sees things going forward.
Thanks for the question, Radhika. I'm quite positive on the financials, especially on the lending side. The stars have aligned maybe after a decade that things are looking good right now. So now if we look, go back maybe 7, 8 years or 10 years and look at the history, the banks made huge provisions, both private and PSU sector banks, right from 2014 to 2020. As a result of that, the entire sector made losses in the year 2017 and 18. The gross NPA number, which stood at roughly 11%, has come down to less than 6%. The net NPA, which was roughly at 6%, has come down to roughly at 1.5%. And after a long time, the sector is making profits, and this year, the entire sector should make a profit of roughly 1.6 trillion or slightly more than that, which translates to roughly 0.8% of ROA, and the trend is on the upward side. Now, if you look at the things were improving 1 year back, and now we can say that things have improved and there is a steady state growth. Last 1 year we saw the non-food credit growth of roughly 17-18%, and that was both helped by higher interest rates in the money market and the low base effect. So now that is behind us. So though growth will be there, but maybe slightly on the lower side in the range of 12 to 14%. But if you see, we have made adequate provisions. So the provisions which were eating away into the profits won't eat away into the profits going forward as well. And in the last 3-4 years, all the banks have raised capital. They are adequately capitalized, both private sector and PSU banks. They are capitalized for growth for the next 3 to 4 years. The most important thing in a lending business is your lender should be adequately capitalized, and the borrower should be also adequately capitalized or less leveraged. So we had a low capex cycle for the last 7-8 years, and we had a fantastic commodity cycle which had helped most of the companies or high capex companies to lower the leverage. And few of the companies on the hinge had also raised capital, so that reduced the leverage. And now we can, if you see at the system level, as Tridip said, that our capacity utilization is in the range of 74-75%. It had gone to as low as 67%, 68% maybe 3 years back. So that is improving, and gradually it will improve further. So we should see some capex cycle coming in within next 12 to 18 months. We should start seeing some green shoots. Currently, if you see, if we compare the capex cycle which happened from 2004 to 2009, the global growth is not as supportive as it was during those times. Mm-hmm. So the capex cycle would definitely kick in, but it won't be as robust as we saw during those periods. So that is on one part.
Just before we get to the second part, the point that I made, that he makes about the stability of loan growth of about 12 to 14% in the context of GDP growth. If you look at what we are talking about, we are hovering around 5 or 6. But the lending is happening at a faster pace, which hopefully shows that the capital creation that we are doing is getting well funded, which is one of the primary reasons being behind our being overweight on lending.
On lending financials.
Yeah, and then secondly, we come to the retail side. Retail has been growing humongously in the last 7-8 years, and if you see our demography, the middle income, currently if you see our GDP per capita is only $2,000. So there is a huge room to grow. If you look at China, China is roughly at 10,000 plus. So even if we catch up, just to catch up at China levels or at emerging market levels, there is a huge runway for growth. So we would see adequate demands from housing loans, personal loans, auto loans. So there is a good runway for growth there as well. So if you look at the inflation has clearly peaked out. The last print was at 4.7%, and the next 2-3 prints would be lower than that.
Yep.
And maybe by the second half or the end of this year, we should see some kind of softening in the interest rates, improvement in liquidity. So from a banking perspective or any NBFC perspective, decline in cost of funds is positive from two parts. First, the cost of raw material, which is money, is coming down, and at the system level, your cost of equity is also coming down. And the valuation of all these banks, and especially the banks, if you see, for these ROEs and these growth rates, they are sustainably on the lower side if you look at the last 10-year history. So that's the reason we are quite positive on the lending part of the financials. And even if you look at non-lending part, the insurance, the AMCs, or the capital marketplace, we have just touched the tip of the iceberg. The penetration level is just 4 to 5% of the GDP. So that continues to be a structural story for in India for then maybe next 10-15 years. There may be some hiccups here and there, adjustments, but the long-term story remains intact very much.
Thanks, Ashwini. I am now going to move to our mid and small cap segment. But before I get into the two specific funds, I just wanted to ask Trideep a quick question that, when you look at the mid and small cap space as a process, since you mentioned FAIR, are there any additional checks that you and the team look at while investing in the segment that you think would be worth sharing with investors?
Yeah. So I think great question. I would say that if you look at, let's say, there are high Sharpe ratio products and there are alpha products. So the high Sharpe ratio products are the large and mid and the flexi cap, where what we are looking to do is present a risk averse portfolio in front of the customer who can take advantage of a bit of alpha, but at the same time can play the market. The high alpha part of the portfolio, we are dealing with either mid cap or small cap or focus. Here we are dealing with customers who can probably take a bit higher on the risk side, but have the time horizon to play that out. And in keeping with that theme, since we are dealing with smaller market cap companies where managements can make a meaningful difference to the trajectory of the company over the next 3-5 years, the first thing that we do is that the emphasis on forensics goes up 1 or 2 notches higher whenever we deal with new ideas that come in mid and small cap. That's the first thing. And Mehul would elaborate a lot of his time before we get into, fundamentally we may find upside in there, but until and unless we are convinced that what we are looking at is a financially clean company, we take a dim view of the stock overall. So higher focus on forensics is one thing that we do. Second, we are fairly actively engaged with the management of the companies, and we insist that we make sure that we have talked to the management before we take an independent view on the company. And sometimes it makes a difference because, as I said, because the size of the company is small, what the company is thinking can make a meaningful delta with regards to the outcome. And hence being in touch with the companies and constantly engaging with them helps us being on the right track. And I mentioned this, do we not do this for others? We do. But for large cap companies, the delta can be only so much. So we track them through earnings calls and various different modes, but for mid and small caps, particularly because we are taking concentrated positions, we want to be clued on what's happening. The final point that I would make is we are mindful of the liquidity risk as we deal with smaller cap companies. So the smallest market cap company of the market cap of the companies we deal with are in the 2,000 to 3,000 crore range. We make sure that companies below 3,000 crore range, market cap range, we have a very strong rationale to owning them. So those would be the 3 things that we do, not I would say additionally, but pay particular more attention to this when we are dealing with mid and small cap companies.
Thanks, Sudeep. So I'll start the section with Edelweiss Small Cap Fund. Now this fund, as some of you know, was launched in Feb 2019. It's completed 4 years, and this is one fund that I think is really delivered on the consistently Q1, Q2, barring a few small periods. So, let's talk a little bit to Sahil. So, Sahil, the same question I asked everyone. I think, what do you think has contributed to the fund's performance over the last 1 year? What has detracted? So, success stories, missed opportunities in terms of sectors and businesses.
Sure, thanks for the question. So basically capital goods is one sector which has done well. Financials is other which has contributed to the returns. China Plus One or chemicals theme has played a good role in terms of contributing to the fund performance. Within the capital goods space, there are a lot of idiosyncratic themes which are there within the small cap capital goods space, whether it is basically companies which are into ethanol manufacturing equipment or companies which are manufacturing equipment which goes into chemical manufacturing. So this kind of companies or companies which are into steel pipe manufacturing or a cables and wires company. So this kind of companies have delivered good alpha for us in the last 1.5 years, along with some of the companies which are focused on the private capex. So these companies have delivered good alpha for us. On the chemical side, it has been more about a selection of stocks which has kind of played out. And in financials as well, again you find a range of companies within the small cap space. Some are housing finance companies, some are lending to SMEs, some of the companies are MFIs or lending to the bigger section of the society. So those kind of different themes or sub themes within the sector, I think it has played out well for us. And in terms of detractors or sectors which has not worked well for us, I think consumer durables is one which has not done that well. And I think IT, because of the way the overall sector has kind of come off, that has been a detractor. But within IT, I think the stock selection has done very well. And as Trideep and Abhishek also mentioned, that we have been underweight IT over last 1.5 years. So I think that is what has done well for us.
Thanks, Sahil. One specific area you mentioned, and I know you cover this space also, is chemicals. Now, this fund over the last year has picked some very interesting businesses in chemicals. So, what has made, if you can talk a little bit about the play that we've done in chemicals, what is making these businesses attractive, and are you bullish on them going forward?
Sure. So on the chemical side, see in chemicals, one can divide chemicals into three basic buckets. One is specialty chemicals, the second one is commodity chemicals, and the third one is agrochemicals. Now, agrochemicals and commodity chemicals by nature are very, very volatile and very, very cyclical. The China Plus One story that has been playing out in the chemical sector over last, I would say 6 to 7 years, it has played out more so in the specialty chemical side of the business. So here the margins of, if I take the top 5 or top 7 chemical companies, the margins or profitability of these companies has gone up manifold. Basically the cost arbitrage the Chinese companies used to enjoy, that has kind of gone away, and that has helped Indian companies to capture those margins, which they have kind of redeployed or replowed that into the business to grow their businesses. So that particular theme within even the chemical bucket, I think has played out quite well, and we have quite a few companies in the small cap fund as well as in other funds which kind of aligns to that particular China Plus One theme. I continue to believe that over next 5 years the chemical theme will continue to play out, and the high growth rates that we have seen in the past, there is a good possibility that these growth rates will continue into the future as well.
So Sahil, there's a question from an investor actually that small caps have underperformed large caps for a long period now, and where do you see the revival, if any, coming? Where and why?
So I think small cap versus large cap, I mean they have been cyclical in the past as well. So for example, during COVID times, small caps underperformed large caps. There was a time period between 2018-19 when small caps had underperformed large caps. In fact, when we look at post-COVID scenario, that is April 2020 to almost till last year, Jan 2022, small caps had outperformed large caps by a very wide margin, right? So this performance typically has a cycle of around 2 to 3 years of outperformance and then a 1 year of underperformance cycle. we have seen in last 1 year that the small caps have underperformed large caps by a good amount of margin. And typically, when we look at the history, such scenarios where small caps have underperformed large caps, in the subsequent years, small caps tends to outperform the large caps, because over a longer period of time, if I take a 15-20 year history, small and mid caps have outperformed large caps by a good margin. So I think from a valuation standpoint, where we stand today in terms of small cap valuation, it is closer to large cap or lesser than the large cap valuations, and the earnings growth, which is typically faster than the large cap companies, that I think should makes a good case to kind of invest in the small caps at the current juncture.
Also, to add on to what he said, if you fit that into what we are saying in the form of recession before rebound, over the last year or so, where macro conditions have been volatile and there have been headwinds abound, in those circumstances, if you ask me, it is only logical that the small caps underperform. And as we move closer to the rebound, which is over the next 2 or 3 years, as long as it happens that way, small caps and mid caps are maybe a good place to start allocating money. That's one way to look at it. The second way to look at it is the starting valuations. A couple of years ago, the starting valuations of small cap were on the higher side versus mid cap, large cap. That has now also come to more reasonable. So whichever way you cut it, this might not be a very bad time to look at the mid and small cap bucket.
Perfect. That's very helpful. Sahil, the last question to you is, going forward, how do you see the small cap fund now positioned in terms of sector overweight and underweight?
So in terms of sectoral overweight, we are still continuing to have overweight on the capital goods space, and within that we like the housing capex theme, which Trildeep also mentioned. In terms of real estate, if we look at real estate as a percentage of the overall capital formation, this used to be around 37% in 2012, which has gone down to as low as 25%. And in last one and a half year, this real estate investment as a percentage of the overall capex spend, which is done at a country level, it has now started inching up after a very long period of time. Also, the other thing that has happened is the inventory levels in the housing side, where the inventory months used to be around closer to 3.5 to 4 years, which has now come down to a more reasonable 1.5 to 2 years. What it does is that it leads to more launches on the real estate side, as well as the new home sales are happening. Finally, this kind of helps the building material companies, which are ancillaries to the housing sales that is happening at a country level. And there are a lot of companies on the building material side, whether you talk about pipes or wood panel company, which are available in the small and mid cap space. So that is one space that we like. The second is the space where we are overweight on is auto. So within consumer discretionary in the small cap space, we are overweight on auto. We believe that the auto cycle has just started. Typically in India, the auto cycle is there for 3 to 4 years, and it is just 1.5 years since we have seen a rebound in the auto cycle after a 2-3 year period of down cycle. So I think autos is another space that we like. I think a dark horse can be a rural theme, where the K-shaped recovery has played out and rural demand has been at the bottom, and from here on there are good chances that over next 2 years rural can rebound quite significantly. So these are the themes that we like, and you will see some flavor of that in our portfolio.
Thanks, Sahil. And I will actually just move to the sister fund now. This is the last fund we will cover, but very important fund, Edelweiss Mid Cap Fund. I think our largest fund in this space. It's recently completed 15 years. I always say, if you look at the last 10-year history, it's among the best in the peer set at any point in time, also in terms of SIP returns. So Trildeep, I think the same question that I've asked everyone else. What's worked well in the last 1 year? What has detracted? What were the missed opportunities in terms of sectors and businesses?
I think one of the things that I like about mid cap as a category is that overall it naturally orients people towards alpha. And let me kind of take a bit to say why I say that. A mid cap category is comprises of companies which are successful small caps. So to a certain extent they have crossed over a certain level of success and to improve their metal. And they are aspiring large caps, if I may put it that way. So on net balance, if you look at the corporate life cycle, the best part or the best years of the youth, so to speak, is nicely captured as long as we do a good job at stock selection, which over the last 10 years with an alpha of about 2% or thereabouts, and of course past performance is no indication of future, but goes on to show that mid-cap investing really works. And the other thing that I would say is that if you just look at absolute returns over the last 15 years, an XIRR of 17%, which is what our product team came about with, just even though I manage the fund, but it just go on to show that over that long time frame, investing and mid-cap investing actually works. And I don't know of many asset classes where you can get that much amount of a return in absolute terms. If you ignore even if you ignore the index returns, where you can get. So that's what makes me quite excited about that category. Now, in terms of the sectors that did well for us, I think by this time the cat is out of the bag. The things that worked for us were capital goods, financials, and underweight in IT. And what didn't work for us was basically some parts of autos and consumer durables.
So same themes across the board, and
correct.
I think that's going to be, some of this is going to sound repetitive, but
correct.
it is one theme,
and
it's important to cover it across portfolios.
Correct. But let me sort of all the things that have been covered, one place that I wanted to talk about is an opportunity which I think India faces is quite unique as we speak now. And what it is overall in India, generally whenever an opportunity strikes home, capacity comes before, and hence there is a margin problem. Profitability takes a knock. This is one opportunity where there is an opportunity overall, but no supply. What I'm talking about is indigenization of defense, and that's probably something that we haven't covered, and I thought I'll cover in a bit in detail. It's adequately reflected in our portfolios, but I would say that this is probably a 10 to 15 year opportunity in the context of India. As a nation, we are probably finally waking up to a situation where we think self-reliance in defense in some form or the other is the way to be. This will for sure have its fits and starts, its successes and failures, and failed starts. But over the long period of time, you will see more and more companies being listed. You will see this theme populate, and at some point being a separate sector in itself in the context of capital goods. At the moment, if you look at this theme's representation in the indices, it's hardly any. But to the extent that we can, we are overweight these themes in our portfolios, and we continue to remain so over a period of time. With a bit of macro stability, I think the opportunities, some of the companies that we speak to on their earnings call, they say that our 20-year order book is full. We basically lack the supply to fulfill them. So it's a meaningful opportunity. Quite a few companies in mid and small cap kind of orient themselves to this opportunity, and hence in the mid and small cap category I mentioned this, and that's one of the reasons why you want to be in this category over a period of time, because you can get exposure to these companies.
Any other themes? Sahil talked about the small cap portfolio positioning. I'm glad you brought up the indigenization of defense. How would you talk about how mid cap as a portfolio is positioned going forward?
Yeah. So I think the themes remain the same. It's basically the subset of companies that you can get to.
Yeah.
And I think overall, when we go to large cap oriented companies, some of the same companies have a smaller growth rate. But here, when you look at mid cap as a bucket, we are talking about as a basket earnings growth of somewhere around 24-25%, which is a good starting point for you want to own those stocks in that bucket, because even if we get the valuation wrong to a certain extent, if it mimics the earnings growth over a reasonably long period of time, the investors are home and dry. This by no means is an indication of what the returns may turn out to be over the next 2 or 3 years. But I'm just saying, as a fundamental construct, when we look at mid caps, the fundamental construct of companies with earnings growth of that magnitude makes it a very ripe source of wealth creation from an investor standpoint.
And I absolutely agree, because while we talk about funds, finally we are holders of businesses, and it's important to look at the earnings profile of some of the businesses that we are holding. Pradeep, the last question I have before I ask a couple of audience questions is, in the context of mid and small cap, of course, liquidity has been a very important factor. The last year hasn't been an easy year, I would say, in terms of markets, all the global headwinds, Abhishek also touched on them. Liquidity conditions have also been patchy. How do you look at liquidity in the context of mid and small cap portfolios?
We are very mindful of liquidity. Liquidity can't be the driving factor of returns.
Of course.
We ultimately look for stock specific alpha, particularly when we are looking at mid and small cap, and hopefully the investors have got a flavor of that. But as a measure of liquidity, we generally tend to look at companies with market cap north of 3,000 crores as a starting criteria, and then whatever the howsoever well the fundamental hypothesis or thesis stacks out to be. That's one place that we're there. Now, one thing is to do. Second is to monitor. We also monitor this on a monthly basis, that the liquidity conditions of the stocks that we own have not really gone south, or if you want to get exit, we can get exit. In fact, as a CIO, I'm pleased to say that for mid cap portfolio and for small cap portfolio, if we were to liquidate, we can probably liquidate 80% of the portfolio in the course of a week. I don't know in many places whether we can say that. It's a good place to be.
Sure. So, with that, I'm just going to end, but I have a couple of audience questions. There's some very interesting ones. Just to the audience, I'm repeating, I'm not taking questions on Edelweiss Greater China Fund, even though there are quite a few of them, because we will do a separate session for international funds. Now, Pradeep, there was a question I got on Edelweiss Focus Equity Fund. We didn't cover that in detail because the fund was only launched, I think, in last June or July, but it's also done well in the limited period since inception. So maybe quickly for the investor who asked the question, if you can talk about the themes that it's positioned for going forward, the three themes that we launched the fund with, and how that thesis is playing out.
It's a great preamble, and I think it's a nice difference from what we talked about. One of the things that we talk if you look at over the last hour or so, we have talked about economic themes, and the issue with economic themes is that economic themes come with cycles, and cycles have a fixed time frame. In the focus fund, what we are looking to do is play themes which are very relevant to India as a country and the stage at which it is in. And the three themes where we found India to be a very in the right place at the right time are number one, brands. As he mentioned, that overall with a per capita GDP of 2000, as we move north, the affinity of people to own brands go up significantly, and we want to play this through some of the stocks that are listed, and there are quite a few nice stocks to be listed in Indian stock market. So that's our theme number one, which is play the brand adoption in the context of India over the next 5 to 10 years. The second one is basically operating leverage. Now, if you look at if you've heard the medium term hypothesis that I have on India, which is that overall the economy seems to be an uptick, then the companies that gain market share would gain disproportionate amount of operating leverage over this time frame. This is what we are looking to play in our portfolios in the second theme, which is rising operating leverage, and it's done quite well over the last 1 year for us. And the final bit is, whether you believe it or not, we live in an era of disruption. Even a 100-year-old sector like autos is being disrupted. What else can we say? So the beneficiaries of disruption is the third theme that we are looking to play through this portfolio. The distinction why we chose these three is that we wanted to digress from the economic themes and have a long dated themes which can run through hopefully a decade or so. And fortunately, in the brief period of time that we are in, that we have been running this portfolio, it has worked well both in absolute returns and relative returns. Hopefully there is more to follow.
Perfect. So Tradeep, last question. It was a really curious question. Someone said that at this stage of the economic cycle, when you see a bull market, why should someone prefer active management to passive investing? A good question to end this part of the section.
I am only talking about historical data. So over the last 12 to 18 months, markets have been broadly flattish. Now, in broadly flattish markets, active investing, hopefully with alpha that we have generated over a period of time, generates returns. What comes out of passive funds, I leave that to you. The second part is in emerging markets. where promoters are gradually kind of gaining experience with regards to running companies. Faux pas or mistakes happen quite often. And I mean, we have been last 1 year, we have seen at least one corporate group get into such trouble. Now, when that happens, as part of a passive fund, as an investor, you perforce own that stock, whereas as an active manager, I don't need to, and I can stay away from it, and hopefully, kind of that generates alpha. So far, we have been able to do a good job at managing the same, and over a period of time, I think the industry and ourselves will prove its mettle through alpha generation. That's the only holy grail.
Thanks, Sudeep. Thank you to the entire team, Abhishek, Sahil, Ashwini, Mehul. I'll call our next team on board, so we'll have a quick changeover. Great. Welcome back, everybody. We now move on to our second and last section, which is the hybrid and solutions fund section. I have the entire team here with me. Bharat and Bhavesh are the co-heads of this business. They are joined by Amit, Bhavin, Prabnoor and Ashish. So that's the entire team. We are going to, while we have multiple funds in this class, we are going to cover two funds today. which are the largest ones and the ones where you guys have sent us the most questions. I'm going to start with Balanced Advantage Fund and then move to recently listed IPO fund next. So Bhavish, I'll cover BAF with you. Now, just before I start, I think Edelweiss BAF, of course, is one of the largest in the category. It's had a wonderful 3 to 5 year run in terms of performance. The last 1 year, we have to admit, has been a little softer, and we are going to talk about that. But Bhavish, for the audience, can you briefly describe first how BAF is different from others in terms of strategy?
Sure, Radhika. I think broadly you can divide this balanced advantage fund category into two parts. Most of the fund in the industry are using valuation as an asset allocation model. So you will hear some fund looking at price to earning, price to book, dividend yield, or some other parameter of valuation. As far as Edelweiss balanced advantage fund is concerned, we are not looking at valuation. As far as asset allocation model is concerned, we are totally on the basis of trend. So the model is known as Edelweiss Equity Health Index, wherein we try to identify the trend of the market, so short-term trend, near-term trend, and long-term health of that trend. And basis these three signals, we decide how much equity we have to keep on a day-to-day basis. So this is the model wherein we look at these three signals on a daily basis. Say for example, our short-term indicator is 1 week average and 2 week average of Nifty. So if today Nifty is trading above a price which is higher than last 2 weeks average, our signal will tell us that short-term trend of market is looking positive, and accordingly we will increase our equity exposure. Similarly, we have a medium-term indicator wherein we look at, you can say, roughly 1 month and 3 month of moving average, and then there is a long-term indicator wherein we look at long-term volatility. Now obviously neither say valuation based model are correct 100% of the time, neither say trend based model are correct 100% of the time, but looking at the historical track record and the success of you can say trend based model, we have decided to select trend based model, and that's why we follow this different model compared to the rest of the industry.
Perfect, and I think we'll talk about the model, but let's just talk about the last 1 year, because there were patches when performance was muted. Now I think there are two parts to a performance of BAF. One is of course the model which you described, and second of course is the stock selection, because a certain part of the portfolio, a large part of the portfolio is equity. Over the last year, how do you look at performance of the model, performance of the core portfolio, because it's very important for investors to understand why something is happening.
Definitely, I think very important for everyone to know that when you look at performance of balanced advantage fund, it is a combination of many things. My stock selection, my hedging model, my allocation to large cap, mid cap versus small cap, my fixed income portfolio. So it is a cocktail of many things. So when you look at say last 12-month performance, it has, so we have, if you compare, Nifty has given you say close to 12% return, we have delivered around 10% return. So we have seen a decent recovery. But if you look at performance of calendar year 2022, where I think our performance was slightly patchy, Nifty has given close to 4% return in that year. Edelweiss BAF has delivered around 2.1% return. And if you look at category average, category has delivered around 3.8% return. So as I told you in the beginning, the model we follow is a trend-based asset allocation model. And now you look at entire year of 2022. Nifty traveled more than 35,000 points in a year. So a 17,500 index at the start of the year traveled more than 35,000 points. But how much money actually the client made? Only 700 points or 4%. That shows that it was an extremely volatile and choppy market, and finally you can see a lot of noise, a lot of volatility, but no direction in market. And because there was no trend in market, our model normally tends to underperform in this kind of environment. But if you'll see, same thing happened in 2018-19 period, we underperformed the category by around 1.3%. Same thing happened last year, we underperformed the category by close to 1.6%. Now within category, you will find some fund outperformed us by say 4% or 5%. So there, I think the second part of the question comes into picture, that is stock selection. As you know, the strategy which we follow, at least in our hybrid scheme, is growth at a reasonable price. So last year was a year where, you can say last 1.5 years actually, from the time when interest rates started going up, value as a theme has outperformed growth. Yep. And that is where our portfolio also took a small beating. And so the combination of say underperformance of growth stock plus a non-trending market was something which led to an underperformance of, you can say overall around 1.3%, 1.5% compared to the category average. But if you'll see in all the trending year, we outperformed the category by say anywhere between 5 to 8%. And in the non-trending year, we underperformed say by around 1 or 2%. But net, if a client say invested for say 3 to 5 years, that is the minimum horizon. We always ask a client to come into a fund like Balance Advantage Fund. I think he gets a reasonable experience with our fund with minimum amount of volatility, and obviously performance wise the numbers are there to see. So we have performed much better on a 3 to 5 year time horizon.
And Bhavesh, there was a question that came from an investor. So I just want to ask, there are lots of myths that, trend-based models or momentum models do well only in good markets or only in bad markets. So, maybe using examples like 2020, if you could clarify when momentum models do well versus not do well.
Sure, I think again, yes. So just to put, say one more myth which you normally get in most of the audience, that our fund is a slightly aggressive fund or we will work only in a particular kind of market. So I'll just give some live example of how we have delivered our performance in some of the historical trending as well as non-trending market. So just to start with the COVID period, if you will see, markets were trading at lifetime high close to 12,500 odd levels around mid of Jan. When markets are at lifetime high, obviously trend is very positive. We were running a very high equity allocation. At the same time, valuations were very expensive, and all this value-based fund were running say 35-40% equity level. So we were at almost 65 to 70%. So just to put in context, the lowest we can go is 30. So most of the value funds were almost towards that, and the highest we can go is 80. So we were almost over there. Now, if someone tells you that within next couple of months, market from say 12,400 will go down to 7,600, that is almost a 38-39% fall. Everyone would have thought or assumed that because we are aggressive, our equity is 65%, others are at 35%, they would do much better than us. But now if you look at the numbers, in that fall of 38%, Edelweiss Balance Advantage Fund was down only 14.8. Whereas you take any other Balance Advantage Fund, the largest one, the fastest growing one, there are different set of Balance Advantage Fund. If you will see, on an average, their fall was 22 to 24%, whereas we were down only 14.8%. Now at the same time, so this is how we were able to protect the downside, almost you can say 10 to 12% outperformance compared to the category, or you can say protection compared to what other Balance Advantage Fund delivered. And when the upside resumed, say bottom of 7,600, we touched almost 18,400 levels in October 2021. In that whole journey of, you can say, close to 150% rally in Nifty, so it was a CAGR return of around 70%. Edelweiss BAF delivered around 42% return. If you will compare all the Balance Advantage Fund, which were down 24-26% in the following period, they delivered 42 to 43% return. So on upside, we are almost equal to them. On downside, we will give you almost 10 to 12% higher protection. So net, when you look at this total return, the total return in this period of almost say 3.5 years, which is a reasonable time in equity, we delivered around 13% CAGR return, whereas the category average was around 10%. Now 3% absolute performance on a CAGR of a 3 year may sound a smaller number to you, that it is only 3%, but a category where we are looking at return of 8%, 9%,
it's meaningful.
3% return is a significant alpha, almost say 40%. And again, coming to the second scenario wherein say markets are range bound for quite a long period of time, you can look at our performance in 2015. Nifty was negative 4% in that year, we delivered positive 4% return. So it is not that always in a non-trending market we will definitely underperform. It is a combination of, as I told you, stock selection, sectoral allocation, large cap performance, mid cap performance, hedging, everything put together. Last year particularly was slightly more tougher for us because both portfolio also underperformed and model was also not performing well. If you will see in 2015, model was not performing well because it was a non-trending year, but portfolio did exceptionally well. And that's why even in a non-trending year, Nifty was negative 4, we delivered positive 4% return.
That's very helpful. Bhavesh, I just, since you talked about the fact that there are many BAF models in the market, so many BAFs were launched last year, has there been a need to enhance the model we use in Edelweiss BAF, to change the model, since this is a model? So it's a question that people ask.
Yes, I think Radhika, see, the most important thing is, first as a fund manager, we should know that what is going wrong with us. Like last year, if we have underperformed the category by 1.5%, we are aware of the fact that in a non-trending market, our models will not perform. We also know the solution to that. The moment we also start using price to earning or price to book or any of the valuation parameter, we can solve this problem. But just to solve that 1.5, 2% of underperformance in a non-trending year, which again happens once in a 3 to 4 year time horizon, so you can say roughly 25% of the time. So to fix my 1%, 1.5% underperformance in a non-trending year, if I try to change my model or if I try to, you can say, adapt to the new set of, you can say, asset allocation tool, I will compromise on my outperformance in the trending market. And as I told you, in say our limited history of say last 6.5 years, when we are running this as a pure balanced advantage fund, we have seen 3 to 4 trending years. In that particular year, our outperformance is anywhere between 5 to 8%. And couple of, you can say, non-trending year, wherein, as I told you, we have underperformed by 1.5 to 2%. So net, if a client stays invested for say 3 to 5 years, he is getting significant alpha compared to the category average. So I don't feel there is a need to tweak our model or to change anything, because the most important thing is we don't want any investor to come in a balanced advantage fund only for a 1 year period.
Yes.
So in 1 year, definitely it is again not only our product. Each and every strategy, each and every fund can have that 1.5 year of rough patch. But till the time long-term track record is better, and that is the duration what we are looking for as an investor to come into a balanced advantage fund, I think our existing model is good enough to continue.
And I think Bhavesh said, one very important thing, that it is important to have a consistency of belief. So if there is a belief that trend is the way to go, and we have the model for a reason, that we have to stick by the model. The last thing we want to be doing is changing the model every year and being reactive. And I think the second important thing he said is that balanced advantage fund has never been a 1 year product. It has been a multi-year product. If you are invested for 3 to 5 years, you do make money. I'm an investor in this fund myself, so I know that. Bhavesh, the last question I have is that performance has of course picked up in the recent months. So a few people are asking, why do you believe that this will sustain? I think you've already answered that, but maybe you can talk about the current asset allocation and the positioning of the equity and debt portfolio, and how investors should think about the next year or two.
Yep. So right now, if you will see the current asset allocation, we are running close to 63% equity. So one of our signal is telling us to stay away from market, and couple of them are telling us to stay long on market. That's why we are close to 63% equity. Say we are close to 20% in debt, and 17% portfolio is hedged. So again, just to touch briefly upon of our equity portfolio and debt portfolio. In equity, we always run you can say a large cap bias portfolio, wherein we put higher emphasis to say growth oriented stock. As far as fixed income is concerned, the average maturity we run over here is anywhere between 1 year to 3 years. We are strictly into AAA rated paper, or you can say sovereign, that is T-bill and G-Sec. So this is how we run our you say overall balanced advantage fund portfolio. Now if you will see Nifty in last 1.5 years, that is almost 20 months, has remained extremely flat. That means there is no trend in market for last you can say almost 2 years now. Last time such phase came was in 2015-16, where for a couple of years Nifty was extremely flat, but then it was followed with a big, you can say, bull year. That was 2017, where Nifty delivered almost 31% return. Similarly, second such phase came you can say in 2018, wherein various other steps like say long-term capital gain tax was introduced. We had our own NBFC crisis like ILFS and a couple of more. Again in that year, Nifty has delivered only 3% return. Again, if you see 2019, 2021, 3 back-to-back double-digit year. So 2022 also should not be a different year. It was a flattish year. Market didn't wear anywhere. And looking at the historical incident, whenever we have seen such a flat year, it has always been followed by a very good big bull equity year, or maybe 2 or 3 good year for equity. So that means we are very near to start of a big bull trend in the market. And as I told you, in trending market, Edelweiss Balanced Advantage Fund will be the best performing Balanced Advantage Fund if you look at last 3 trending bullish trending year. So that's why we think this is a time wherein people should look at our fund more closely, and if they want to, you can say, create significant wealth in this upside swing, definitely Edelweiss Balanced Advantage Fund is the fund to be.
Thanks, Bhavesh, and there are lots of questions on this, so I may also come to you later.
Yep.
Let me now move to Edelweiss recently listed IPO fund. Before I get into the fund, Bharat, of course, the context for last year is, very, very extraordinary. Interest rates have done what they had to do. You've seen sort of the slowdown in growth stocks. But can you talk a little bit about how the IPO market has been last year and also how it looks going ahead, and then we'll come to the fund.
Thanks, Radhika. So IPO market is always, if you look at it, has ebbs and flows kind of stuff. It happens of. We have seen good years of IPO market, and there have been some kind of downside in IPO market. If you look at it, 2023 financial year kind of stuff, you would see actually there were 39 IPOs which came in. this has been lower as compared to what we have seen in 2022, where we had something like 51 IPOs which came in. But it's higher than the 10-year average. 10-year average is typically 22 to 25 IPOs in a year kind of stuff. So the IPOs have been there in 2023 primarily from the fact that many of the IPOs which have come in has come at a decent valuation as compared to what we have seen in 2022. If you look at the median performance of IPOs which have come in 2023, they have delivered close to around 9% returns in 2023. So if you look at it, overall IPO market has been strong to that extent when you compare with the historical trend. But what has turned well bad is the 2022 IPOs which have been actually listed in a very bull kind of scenario. As you rightly said about it, many of these environment has changed dramatically for IPO market. If you look at the interest rate environment has dramatically changed. If you look at the commodity cycle have changed dramatically over a period of time because of Ukraine, Russia war kind of stuff. We have seen quite of outflows from the FI piece which has led to a lot of IPO market. Having said so, that is one part of the story. How we look at forward, that is important part of the story for IPO market. If you look at it, IPO markets has a function of how capital market perform. If you look at it last almost 2-3 months, a lot of things have changed by kind of stuff. Interest rates have started stabilizing, and you would have seen IPOs listing happening decently in recent past. We would have seen some of the pharma companies listing happening decently to kind of stuff. That has set ball rolling again for the IPO markets. In our opinion, if the market remains stable, the IPO market should come back very strongly. To that extent, there are almost 54 companies which are lined up for IPO for next year kind of stuff. They are in various stages of approvals. They are in discussion with the investment bankers, the qualified institutional participants, and so on and so forth. The discussion is more on to valuation, which was a concern of FY22, which has been somewhere corrected in FY23, and hence we are seeing a lot of interest which is coming back in the IPO market. So we are seeing a good amount of traction in IPO market, and hopefully this should continue.
So I think that's good news for investors. Now, let's talk specifically about 1-year performance, and I just want to contextualize the discussion before I come to you. So if you look at the IPO fund on an absolute basis, returns have not been exciting over the last 1 year. I think there's been a recent recovery, but if we had had this conversation 3 months ago, the last year would have looked negative. That said, the fund has of course done well compared to its benchmark, which is the last 100 IPO index. Now, in your view, what has hurt in the last 1 year? While relative performance has been good, investors of course look at absolute performance. So what has hurt beyond, sort of all the stuff that you've said in question 1?
So, right, Radhika, obviously people look at absolute performance, and we are here to deliver absolute performance from a perspective, from a 3 to 5 year perspective. But if you look at it, the way things have changed dramatically in the macro environment, that has led to the size. And it's not very peculiar to Indian IPO markets. If you look at global IPO markets, the global IPO ETFs, which if you track it out, has been down close to around 20 to 30%. If you look at some of the NASDAQ stock, the technology oriented companies where there are growth companies, they are down anywhere between 20 to 50% kind of stuff. So it's not very peculiar to Indian IPO markets, but it's across worldwide you have seen such kind of thing. And there are 3-4 reasons broadly, if you look at it, what has happened, transpired to this kind of fall. Primarily one of the biggest reason is the interest rate regime. If you look at it, when we were sitting in 2021, the interest rate regimes were different. So when you discount the cash flows of earnings of the companies which are primarily growth oriented in IPO space, you would see different kind of valuation as the interest rates have dramatically changed over a period of time. In US context, it moved around close to 500 basis point, which has resulted in some amount of softness in the valuation of many of the companies. You have seen similar kind of thing happening in the private equity space. We have seen similar thing happening in the public listed space. Second important aspect about is the small cap. Overall, if you look at it, the small cap indices have fallen substantially. If you look at it, since the fund was open-ended kind of stuff, small cap index has delivered flattish performance, and so is the case with the IPO fund, which has delivered flattish performance. So it's primarily in line with that. Third important factor, if you look at it from a perspective, is that there has been a huge volatility in market, and I'm just saying this is not only about interest rate, but it's also about commodities. also about inflation and a lot of other aspect to it. Consequently, in such kind of market, people tend to actually move towards more safer horizon kind of stuff, and people have moved more towards large cap, more towards debt, and so on and so forth. Typically, IPO stock requires some time to actually deliver performance, and if you look at it in 2021, there were 51 IPOs which came in 2022 kind of stuff. We have seen similar kind of numbers kind of stuff coming in. So you would have looked at, we have to give time for these IPO companies to deliver performance, and when we look at the earnings growth of these companies, they have been pretty strong to that extent. I am just saying we are looking at quarter on quarter how the earnings growth has been progressing. We are seeing earnings growth has been pretty much on track. If I look at last 4 quarters of earning growth, I am saying June, September, December, March, we are seeing consistently 28 to 30% earning growth of the core portfolio. And as these earnings growth are coming in, actually valuation have come down to an extent that it looks very interesting from here on kind of stuff. So if you look at it in totality, the fund has done well with respect to benchmark because the stock selection has been good. But the performance need to be evaluated on 3 year horizon. As the earning progression tracks out, you would see actually absolute performance also happening. This is not the first time we have seen this kind of performance. You have seen this fund is almost like more than 5 years old. We had seen similar kind of thing happening in 2018. We recovered well back kind of stuff. We started with a NAV of 10 rupees, it went down to 8 rupees, then we moved to 11 rupees, that came down to 7.5 rupees, it moved to 16 rupees where it made open ended, and then we went as high as 21, 22 rupees. Now we're closer to 17 rupees of NAV. We think there is a lot of opportunity in this fund, given that if you look at it, the previous section we had discussed a lot about small cap as a theme to play around. We have a lot of interesting idea to work around in the IPO fund, and that's the interesting piece for us.
I think I just want to re-emphasize 2 points that Bharat made. One is the importance of duration in this fund and time horizon. Because such a large component of the fund is mid cap and small cap, you need to give the fund a certain amount of time horizon. And he also talked about the fact that this will be volatile. So for investors, it's not an ideal thing to hear. Volatility is not something that we often like to hear. But the fact that the fund has experienced this kind of volatility before is important. The second thing he said is that the businesses here are solid businesses. These are businesses where he talked about the fact that companies are growing at 20% plus and your valuations have corrected. So I think for existing investors that should give you confidence about the future. Now Bharat, I want to just ask you 2 last questions. One is about the IPOs you avoided and subscribed to last year, and specifically because of last year and the noise around some of these tech IPOs and new age companies, there's a belief that all IPO companies are bad. People sometimes don't know which ones we subscribe to, and we are quite selective on this. So I think it's important that you talk about that.
It's very important to understand IPO is a good space to identify multi-baggers, but there are also a lot of pitfalls in IPO market. All IPOs don't make money, that's the reality of the life, and somebody has to be very, very selective in it. We have been always selective. If you look at our historical standards, we have been selecting 1 out of 3 IPOs in general. If you look at it, last year we had around 39 IPOs. We selected out of 13 IPOs. If you look at performance of these 13 IPOs which we had selected, on an average they have delivered close to around 20% return, which is higher than the 12% return of the universe which companies have come in. So selection remains paramount important kind of stuff. In terms of the kind of IPOs which we looked out, there are few themes which have come in last 1 year. We had seen some of these hospital companies have started coming in for IPO space. You would have looked at on some of these hospital companies where the occupancy levels have risen substantially over period of post-COVID kind of stuff. You would have seen actually the average revenue per bed has increased substantially. So many of these hospital companies have started coming in for IPOs. We liked a few of them and we have participated in a few of them. Some of the companies in the chemical space where the niche segment they were operating in has come in for IPOs. We have participated in a couple of them. They are actually catering from a China one policy kind of environment. They are catering to some of these niche molecules which are interesting and they are themselves market leaders in it. So we have participated in some of those chemical companies. We have also participated in some of the lending companies. We had refrained from being in lending institution in 2021. We would have actually participated more in 2022 calendar year. We have participated more in lending companies, some of these NBFCs, microfinance institutions, the small ticket lending institution, we have participated in some of them. So those are the areas where we participated in. This year also we had seen one of the biggest IPO in the Indian market context, quite listed kind of stuff. The insurance company got listed kind of stuff. So we have seen a huge amount of media coverage around the listing of it. We have been away from many of the large listing kind of stuff. We have to be very cautious while actually subscribing to large IPOs. One need to be very cautious. We have been historically seen some of the IPOs, whether in insurance space, earlier also, whether it's the general insurance space or the health insurance space, we have seen pitfalls kind of stuff. So we have been very cautious in it. We have also been very cautious in some of the new tech IPOs of late kind of stuff, given that interest rate environment had dramatically changed. So we have not participated in some of the IPOs in the logistics space, where we have actually primarily avoided kind of stuff. So that is the area where we have avoided IPOs to that extent.
Thanks, Bharat. And I think, to reiterate the point, I think many of the marquee IPOs are IPOs that, we've skipped. The last question I have to you, Bharat, before I open it to the last round of audience questions is, and I'm seeing a couple of audience questions on this, is for existing investors and potentially new investors. How is the portfolio positioned currently in terms of themes, sectors where you have, or businesses where you have, without taking names, high conviction? If you could talk about that. I think you already talked about quality of the portfolio. So
the IPO fund, if you look at it, has unique themes which we are playing around it, and some of the themes Trideep has mentioned around it, and these themes are actually very interesting from an IPO perspective. Trideep spoke about it, about defense, indigenization of defense theme as an important factor. If you look at it, some of the companies in the IPO space have actually come in that market. Looks very interesting from a proposition. So we are playing the indigenization of defense as a theme in our portfolio. Second theme which we are playing extensively is the consumer story kind of stuff, where we have ample of opportunities as India is moving from a 3 trillion to 5 trillion economy. A lot of consumer stories are going to come up for Indian context. We have seen some of the wedding apparel companies have come in, some of the footwear companies have come in for market, some of these retail shops have come for market. And we are seeing a lot of opportunities in this space. We think there is a huge runway for growth for many of these companies. The third important theme which we are playing on the auto ancillary piece, which we think there is a lot of opportunity in the auto ancillary space. Some of these companies are actually catering to the new age vehicles kind of stuff, whether it's electric vehicles, whether it's automatic vehicles, or whether it's luxury vehicles kind of stuff. So there are a lot of opportunities in this. So these are three broad themes we are playing from the context. We think opportunities are huge. If you look at the pipeline of IPOs, the same kind of themes are actually coming up, whether you look at it in the EV space, whether you look at it in the IT space, whether you look at it in the consumer space. So these are the interesting themes which we are playing in the IPO part.
Thanks, Bharat. What I'm going to do for the next 15 minutes, I know there are a lot of questions, so I'm going to try and go through them. If there are any for Bharat and Bhavesh, I'll take them. If there are any for the AMC, then we'll also take them. So there were a couple of questions on recently listed IPO fund. I think what Bharat has said has largely covered it. There were some questions on the downside protection that BAF has talked about. I think Bhavesh has already talked about the performance of a fund like BAF in 2020 and the fact that in extreme downside markets, BAF has actually delivered because of the unique momentum model. There was also some question around the recent underperformance of BAF compared to some other categories. I would always reiterate one point is that, one should not look at this year to year. I remember a very popular balanced advantage fund that is currently at the top of the charts, and I won't take names, and that this question is being asked. 4 years ago when Bhavesh was talking about this correction in March 2020 and Edelweiss BAF fell one of the least, this fund fell nearly 80% of market. So I think different strategies work at different points in time. What's very important to understand is what the strategy of your balanced advantage fund is, and I repeat, holding it for a long period, because different results are, different funds have different performance year on year. So lots of questions around BAF. Some question about Edelweiss MF has been a pioneer in debt TMFs but has not launched an equity or balanced TMF. I would say post the debt taxation change, our team has been doing a lot of thinking. Thank you for the love for our target maturity funds. And I think we are going to be launching at least 2 to 3 new funds this year. And while I won't say equity or balanced TMF, I think there are at least 2 new ideas that will make all our investors extremely happy. There was a question on, there are a couple of questions on Bharat Bond I'll quickly take. Were investments made in March 2023 available for the tax benefit? Yes, they will be available for the tax benefit, but the fund would have had to complete 3 years if you bought 23 rolling into 25. So that's just something. I think if you bought in March 23, you wouldn't complete 3 years if it matures into 25. There is a question about 25 and will we get a merger option into 2030. Our endeavor is to give you a merger option in 25 like we gave you in 23. Which fund we will give it into, whether it's 2030 or we do launch an earlier Bharat bond, that we will decide, but I think our intention is quite clean. There was a question, maybe Bharat or Bhavesh can take it. For 3 years, would you do a balanced advantage fund or an aggressive hybrid fund? We have a smaller but very popular and very well performing aggressive hybrid fund. So this is like asking someone to choose between children, but one of you can answer.
So yes, looking at say current, looking at the current valuation, I think obviously this is a time where we are advising our client that they can definitely look to say increase their risk by 1 notch. So I think in current environment, I will say aggressive hybrid fund will make much better sense with a 3-year view. But again, it depends from individual clients to clients, say risk profile. If say from here in 3 years, definitely aggressive hybrid fund can deliver better return, but it will be slightly more volatile compared to balanced advantage fund. So if someone is ready to take that volatility, which can happen because of some global or some domestic event like elections lined up, then one can select aggressive hybrid fund. But with the 3-year, 5-year, 7-year horizon, I think both this product will give you much better risk return, say risk adjusted return compared to all other sets of products available in the market.
Let me ask the next question to Bharat, although Bhavesh covered some of this. What factors should a consumer consider when evaluating balanced advantage funds?
So when you are looking at balanced advantage fund, one of the important aspects one should look at it is that the consistency of performance has to be across cycles, not only in the up cycle but also in the down cycle kind of stuff. So that is important part of it. Second important part of it, you have to stay around in a fund for longer period of horizon to actually get benefit out of it. Moving out from one fund to another fund will not help you out. It's as a changing lane from traffic, from one traffic lane to the other traffic lane. It doesn't work well for a balanced advantage fund, because primarily if you look at it, the balanced advantage fund itself does timing in terms of when to get into equity markets and when to get out of the equity markets. So if you have chosen certain set of car along with it, ride in that car and actually you will get benefit out of it. Thirdly, if you look at it, when you are selecting a balanced advantage fund, and if you want to select only one balanced advantage fund, look at the company, look at the structure of the market. If you look at it in Indian context, Indian markets is more trending market as compared to more non-trending market kind of stuff. India is, if you look at last 20 years of data, actually 75% of the market has remained trending kind of stuff market. So if you want to select a fund individually basis, you should select a trend based model which works well in a longer run price horizon.
Perfect. Thank you so much. Let me take 1 or 2 other questions that we've got. This is a hard one. What does Edelweiss AMC want the audience to take away from today's open house? Top 1 fund from each: equity, debt and hybrid. I think it's hard to choose funds, guys, from equity, debt and hybrid. What we want you to take away, let me answer this question differently. I think a few things. One is, if you look at the people sitting on this panel and the group of managers that you saw sitting on the last panel, over the last 3-4 years of building this firm, and with all of your love and support, we've really invested in building our investment team. So for the size of AMC, we've actually built a lot of investment capabilities. One very unique thing about this business is that you saw a different team having a conversation with you about long only funds and a dedicated team which specializes in hybrid funds, and I don't think that exists. This is the kind of importance we place. So each team is actually managing a limited number of funds, whether long only or hybrid. And I think what I want you to take away is that we pay serious attention to managing your money. The other important takeaway for all of you that I hope comes out of this is that transparency is important. Now, not all of our funds will do exceptionally well in all periods of time. It is humanly impossible to do that. But what is important to know is that we are here to answer questions in good times and bad, and we are here to answer questions honestly. And I hope that this open house, which is actually running for the 3rd year, has given you that sense of perspective that your AMC and your fund managers, the people who manage money, are there to talk to you. So I think that is important. And third is that, we run a very wide suite of products. We are not an equity house, we are not a fixed income house, we are not a hybrid house. We hope to be an asset management company that provides good solutions to all your financials problems. The solutions could be something like a small cap fund or a balanced advantage fund or a target maturity fund, but we provide solutions and we want to provide good solutions in all these categories, and I think there are great funds to choose from. So there are funds like BAF and aggressive hybrid in the hybrid space, which are wonderful funds. There's a whole suite of target maturity funds, the Edelweiss arbitrage fund, which I didn't talk about, in the debt or debt equivalent space. I think, we've had a wonderful conversation about funds like mid cap and small cap on the equity side. So I think the entire range is there, and that's what we want to do. The last question let me take is that, we've seen a couple of AMCs have had issues despite so much monitoring and tracking. How do we give confidence to investors that we are super compliant? Look, I think risk and governance is extremely important to us, and I'll give you a personal reason why this is so. I think we are a young brand. 5-6 years ago, this AMC was 6,000 crores. It's more than 1,06,000 crores today. And it's largely been built without the backing of a big bank-based brand or anything like that. So whatever it is, it's been built on investor confidence and investor love, and we realize it's just the beginning. So I think we take brand Edelweiss, AMC and all of your feedback very, very seriously. In fact, a couple of years ago, we put in place this policy in our hybrid funds and fixed income funds, and we put in place before anybody mandated it that we would not invest in the debt or equity of any group company. It's on our website. Well before regulatory disclosure guidelines, we'd started disclosing our debt portfolios, on a much more frequent basis. 2 years ago, again, well before, ahead of any regulatory guidelines, we put in a governance committee at Edelweiss AMC that has a very active governance agenda in terms of monitoring things like insider trading, front running, dealing, brokerage empanelment, etc. Finally, I think actions will speak louder than words, and I'm very proud that in our history, we've been very clean in terms of our regulatory compliances and our governance that goes beyond regulation. So I do believe actions will speak louder than words. But I think transparency, commitment, and building the brand is very important to us. So I would say that. With that, I would just want to thank everyone who participated in the open house. The turnout was very large, and many of you have been very patient in listening for 2 full hours in a digital environment across so many funds. Please do send your feedback on this open house to our team via your advisor or through any email or social media channels. To those of you who are sending in wonderful comments on the chat window, we are reading all of them. Thank you very much for your love and support, and we hope to be back with this open house next year for the same conversation on funds. Thank you very much and have a lovely weekend.